A veteran analyst, who called the last two major silver explosions, just issued his most urgent warning yet. What he's predicting for the next 6 months could rewrite everything you know about precious metals, but most investors won't see it coming until it's too late. During the year, I think we'll be well in the hundreds on silver. Something very dramatic is going to unfold, and it will not be incremental. You're watching Currency Matters. Subscribe for more. Silver isn't just breaking out, it's shattering the rules. In a matter of weeks, it's transformed from a quiet sleeper to the most volatile, headline-grabbing metal in the financial world. But while the mainstream scrambles to explain the chaos, one man predicted it coming. Michael Oliver, a veteran market analyst with a track record of identifying major momentum shifts, says this is only the opening act, and if he's accurate, we're about to witness one of the most explosive silver runs in history. This isn't just another rally. According to Oliver, silver is entering what he calls a new paradigm. Not $50, not even $70. He's talking triple digits. And he's not alone, because underneath the surface of these wild price swings lies a seismic shift, one that's been developing for years and is now finally erupting. The financial establishment has kept silver suppressed, confined within artificial boundaries that no longer hold. And now, those walls are crumbling. The question isn't whether silver will reach new highs. The question is how high it can go before the momentum exhausts itself. And more importantly, who will be positioned to capitalize on what could be the wealth transfer of a generation? Because make no mistake, what's happening right now in the silver market represents an opportunity that comes along perhaps once in a lifetime. So what triggered this surge? Why is silver behaving like a coiled spring finally let loose? And how high could it really climb? More critically, what does this mean for your portfolio, your purchasing power, and your financial future in an era where traditional safe havens are being questioned like never before? Stay with me, because what's unfolding in the silver market right now might just be the financial story of the decade. And you're not going to want to miss it. I love it when I listen to the financial networks and my son Brett monitors all the activity going on in the internet, the advisors there and so forth. And everybody, when silver drops hard, that's when you get news stories about it. Rarely do they cite the fact that it's been surging for quite a while, especially this past month. But when it drops big, there's the headlines, and so that draws everybody's attention. The mainstream financial media has a peculiar relationship with silver. They're quick to declare it dead on every pullback, yet strangely silent during its most powerful advances. This isn't coincidence. It's a pattern that's played out for decades. The same institutions that downplay silver's rise are often the ones with the most to lose from its revaluation. Banks with massive short positions, financial entities that rely on the dollar's supremacy, and legacy systems threatened by alternative stores of value. And there's all kinds of narratives that surround silver, that some of which are accurate and some not, but about, this institution is going to do this, or this exchange is going to do that, and that's going to wreck the whole market, etc. You got to be aware that what's underneath this beast in our assessment, and so far we're correct, is that it is going to a new paradigm. Silver's not going to have another $50 up, move out of the range from 0 to 50, basically for 50 years, and go up, and everybody's going to think around 100 naturally. That's a swing move. The dimension of the prior base. We think we're heading to a new reality in the hundreds of dollars, and I think we're going to achieve it in about 6 months. Think about that for a moment. 6 months, not 5 years, not a decade. 6 months to potentially witness silver quadruple or more from current levels. This isn't speculation based on hope or hype. This is analysis grounded in decades of market structure research, momentum studies, and historical precedent. Oliver isn't some newcomer making bold predictions for attention. He's a seasoned analyst who's been studying market dynamics since before most of today, his traders were born. Our clock started at the close of November. At that time, the price of silver was in the mid-50s. It was based on a signal we got from our relative performance analysis, spread chart analysis of silver versus gold, gold versus the S&P, gold miners versus gold. All of these metrics said, we just shifted in a big way at a relative performance basis. When that occurred in '79 in the rush to the 1980 high and in 2010 to the rush to the 2011 high, big multiple gains in 6 months that spread broke out silver versus gold. We've had a situation since 2020, basically, of silver sort of underperforming gold. It's rising in price along with gold, but less so, and therefore the spread relationship has been like a capped-off ceiling. For those unfamiliar with spread analysis, this is critical to understand. When silver underperforms gold, it means, even though both metals might be rising, gold is capturing more of the monetary fear, more of the safe haven demand. It's as if silver is being held back, restrained by invisible forces, while its bigger brother gold runs ahead. But when that relationship flips, when silver begins outperforming gold, it signals something profound. It means the market is recognizing silver's dual nature, both as a monetary metal and as an industrial commodity, whose supply is rapidly depleting. You broke through the cap at the November close. Now, and sure enough, if you use that as your metric and it said this is just the beginning of a massive shift of silver versus gold and also of net price, then the clock just began there. So it's not old, it's fresh. And our argument is looking at lots of metrics that the moment everything transformed wasn't when silver hit 84 or when it snapped back up after a vicious sell-off. It was the end of November. That's when Michael Oliver's models triggered a major alert. But this wasn't about price. It wasn't about headlines. It was something deeper. Oliver tracks momentum, specifically the relationship between silver and other key markets like gold, the S&P 500, and gold miners. And what he observed in late November was a massive structural breakout in the silver to gold spread. For years, silver had lagged gold, caught in a frustrating range. But then, snap, the cap broke. Silver didn't just outperform, it exploded through a multi-year ceiling of resistance. This breakout wasn't gradual, it wasn't tentative, it was decisive, powerful, and unmistakable. The kind of technical signal that separates noise from genuine paradigm shifts. And for those paying attention, it represented a clear inflection point. The market was telegraphing its intentions. Silver was done playing second fiddle. It was ready to reclaim its rightful place as a store of value, a hedge against debasement, and a critical component of the modern technological infrastructure. According to Oliver, this type of spread breakout only happens at historic inflection points. He points to 1979 and 2010, the last two times we witnessed a similar move. In both cases, silver surged multiple times over in just 6 months. That's the clock Oliver says started ticking in November. The price back then, mid-50s, that wasn't the top. That was ground zero. Everything since has been confirmation. And if history is any guide, this breakout isn't noise, it's the signal. The kind of signal that rewrites the script for the entire precious metals market. The 1979-1980 silver surge saw prices rocket from under $6 to $50 in a matter of months. The 2010-2011 run took silver from $18 to nearly $50 in less than a year. Both moves were explosive, both caught the majority of investors off guard, and both created extraordinary wealth for those positioned ahead of the curve. Now we're potentially on the cusp of a third historic move. But this one comes with even more powerful fundamentals backing it. The supply deficit is worse. The industrial demand is higher, the monetary instability is more pronounced, and the global awareness of precious metals as alternative currencies is greater than ever before. Silver is likely in the next 6 months to minimum reach a couple $100, and possibly more than that, and going to a new paradigm, not this 50-year range it's been confined in, which most, actually, commodity markets have not been confined in that sort of range. Copper hasn't, lead hasn't, but silver has, and it's saying no more. Okay? And it's not going to do it in a slow staircase corrective process manner. The fact that silver has been uniquely suppressed compared to other industrial commodities tells us something important. While copper, lead, zinc, and other base metals have been allowed to find their natural price equilibrium based on supply and demand fundamentals, silver has been artificially restrained. Why? Because silver occupies a unique position. It's both an industrial metal and a monetary metal, and allowing it to trade freely threatens the perception of fiat currency stability. But markets have a way of correcting imbalances, regardless of how powerful the forces trying to maintain them. And when these corrections happen, they tend to be violent, swift, and unforgiving to those on the wrong side of the trade. So what we've stressed to our subscribers for some time is that you've got to somewhat ignore the type of events that we just experienced yesterday, which, usually it takes a week or so, and you get a 10 or 15% pullback, and then it takes you a couple months to climb up and take out that high. That's not the pattern now. Look back at October as a good example. We hit a high, and we had a sharp break that lasted a couple weeks. Much of it occurred in the first week, but you couldn't get back to the high for about 3 or 4 weeks later. So you got whacked, but still it was pretty fast recovery given some of the other behavior of silver the last few years. This time it was a 24-hour event. We went from a futures high at 82, dropped down almost to 70, and turned around today and hit 78. I mean, it didn't fool around, it didn't base, it didn't prove itself as support before it turned up. It just said, bam, back up. Okay. This is the hallmark of a market under accumulation by powerful hands. When prices drop sharply and are immediately bid back up, it tells you that there are buyers waiting in the wings, ready to absorb any weakness. These aren't retail investors panic buying. These are sophisticated players, institutional entities, sovereign wealth funds, and central banks who understand what's coming and are positioning accordingly. In fact, we're back up trading now above the high close that occurred high settlement price on Friday. So this is the kind of behavior that investors need to be aware of, that it is going to be part of this explosive advance, and just don't get upset by it. In fact, if you try to exit, the problem is getting back in, because sometimes it's not going to give you a nice base from which to buy from. It's just going to go whap right back up and you'll say, what do I do now? So anybody who exited yesterday in the middle of that collapse, for example, is already behind if they buy back in. Don't get out. Now in about 6 months, we'll be trying to define a place to then exit after silver has reached a new reality, because there will be major correction at some point, but I don't think you're going to see it until we get well into the second quarter. The fact that silver has been uniquely suppressed compared to other industrial commodities tells us something important. While copper, lead, zinc, and other base metals have been allowed to find their natural price equilibrium based on supply and demand fundamentals, silver has been artificially restrained. Why? Because silver occupies a unique position. It's both an industrial metal and a monetary metal, and allowing it to trade freely threatens the perception of fiat currency stability, but markets have a way of correcting imbalances, regardless of how powerful the forces trying to maintain them. And when these corrections happen, they tend to be violent, swift, and unforgiving to those on the wrong side of the trade. So what we've stressed to our subscribers for some time is that you've got to somewhat ignore the type of events that we just experienced yesterday, which, usually it takes a week or so and you get a 10 or 15% pullback, and then it takes you a couple months to climb up and take out that high. That's not the pattern now. Look back at October as a good example. We hit a high and we had a sharp break that lasted a couple weeks. Much of it occurred in the first week, but you couldn't get back to the high for about 3 or 4 weeks later. So you got whacked, but still it was pretty fast recovery given some of the other behavior of silver the last few years. This time it was a 24-hour event. We went from a futures high at 82, dropped down almost to 70, and turned around today and hit 78. I mean, it didn't fool around. It didn't base. It didn't prove itself as support before it turned up. It just said, bam, back up. Okay. This is the hallmark of a market under accumulation by powerful hands. When prices drop sharply and are immediately bid back up, it tells you that there are buyers waiting in the wings, ready to absorb any weakness. These aren't retail investors panic buying. These are sophisticated players, institutional entities, sovereign wealth funds, and central banks who understand what's coming and are positioning accordingly. In fact, we're back up trading now above the high close that occurred high settlement price on Friday. So this is the kind of behavior that investors need to be aware of, that it is going to be part of this explosive advance, and just don't get upset by it. In fact, if you try to exit, the problem is getting back in, because sometimes it's not going to give you a nice base from which to buy from. It's just going to go whap right back up and you'll say, what do I do now? So anybody who exited yesterday in the middle of that collapse, for example, is already behind if they buy back in. Don't get out. Now, in about 6 months, we'll be trying to define a place to then exit after silver has reached a new reality, because there will be major correction at some point, but I don't think you're going to see it until we get well into the second quarter. The psychology of trading a parabolic move is completely different from trading a typical bull market. In a normal advance, you get pullbacks that allow re-entry, consolidations that build support, and technical patterns that give clear signals. In a parabolic move, all of that goes out the window. The market moves too fast. Pullbacks are shallow and brief. And by the time you're convinced the bottom is in, the price has already run away from you. This is why Oliver's advice is so critical. Stay in. Ignore the volatility. Focus on the bigger picture. Because trying to trade in and out of a momentum explosion like this is a fool's errand. You might catch 1 or 2 swings, but eventually you'll be left on the sideline watching the move happen without you. Just before we continue, we just launched the official Currency Matters Telegram. To kick things off, we're running a 10 O's silver giveaway. Yes, real physical silver. Not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10 O's silver giveaway. Be subscribed to Currency Matters on YouTube. Turn on the notification bell, comment 10 O's giveaway on 3 separate videos. Be an active member of the Telegram group, and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active. What happened next caught everyone off guard except Michael Oliver. On the surface, it looked like chaos. Silver surged to nearly $84 in overseas trading, only to crash down to $70 and bounce right back up to $78, all within 24 hours. To most analysts, that kind of volatility screams danger. But Oliver saw something else. He saw acceleration. In his view, these violent swings aren't signs of weakness. They're signs that silver is now operating under a completely different set of rules. The traditional pattern, rally, pullback, slow grind higher, that's gone. This market isn't waiting around to build a base or confirm support. It's snapping back instantly, reclaiming losses with a speed that punishes anyone who tries to trade in and out. And that's exactly what makes it dangerous. Not for those holding, but for those hesitating. The people who sold during the drop were already underwater just a day later. There was no time to re-enter, no clean second chance. It's the kind of behavior Oliver has warned about for months. Sudden drops followed by even more aggressive surges, all part of a fast-moving revaluation. This volatility serves another purpose. It shakes out weak hands. It creates fear and uncertainty among those who aren't committed to the thesis. And it allows the strong hands, those who understand what's really happening, to accumulate more at temporarily depressed prices. It's a wealth transfer mechanism, moving silver from those who panic to those who understand the bigger picture. This isn't a healthy correction. It's a tectonic shift. And as Oliver puts it, once these momentum dynamics are set in motion, they don't stop halfway. They build, they intensify, and then they break through everything in front of them. When the spread broke out last month, forget the net price of silver or gold. Quit looking at their charts, okay? But when that relative performance spread broke out, it broke through a multi-year high of where silver had continually gone to bump against the price of gold, where it created a ceiling of resistance that it couldn't perform better than that level when it broke through last month. Silver's at $22 on the month. 1 month, it's already been in a bull market. Why did it suddenly surge $22 in 1 month? The spread said the game has changed. And I think the game will continue for a couple quarters, and once it's over, we'll look back and say, oh golly, wish I were there. Well, the way to stay there is to stay long until certain metrics that we're monitoring say, okay, now we've maybe reached the level and probably even overshot a reality level. So if silver is justified to be a couple $100 an ounce, like if you take M2 money supply and go back to 1980 and factor in the money growth, depreciation, and the buying power of the US dollar, and then calculate where silver might be, it would be a couple $100 probably. There's no question about that. But if that's where it's going, it's likely to overshoot it, as most markets do. If they've made a big mistake, they often overshoot the correction of the mistake. And so be ready for that. And there's another thing going on with silver that people seem to be focused on silver itself, like the industrial supply-demand deficit that it's been around for 5 years now. Why didn't it work 3 years ago? Well, suddenly it's starting to work. Okay, well, you don't have enough silver to meet demand, especially high-tech demand. The industrial story alone is compelling enough to justify significantly higher silver prices. We're talking about a metal that's absolutely essential to the green energy transition. Every solar panel requires silver. Every electric vehicle contains silver. The entire semiconductor industry depends on silver. And there's no substitute that can match its unique properties: highest electrical conductivity, highest thermal conductivity, most reflective metal. These aren't just nice-to-have characteristics. They're mission-critical for modern technology. And here's the kicker. Unlike gold, which gets recycled at high rates, most silver used in industrial applications is consumed and lost forever. It's spread across millions of devices in quantities too small to economically recover. This means the above-ground supply of silver is actually shrinking, even as demand accelerates. That's a recipe for a supply crisis. And supply crises don't resolve with modest price increases. They resolve with price shocks that force demand destruction or bring new supply online. A new silver supply takes years to develop. Everybody's focused on those aspects of silver, and also they're all panicked by the potential that, oh my gosh, the COMEX will raise the CME, will raise the margin requirement. Well, they've been raising it all along. I think it was like a 13% jump on Friday, in fact, where they raised the margin rate. And in 1980, the chairman of the COMEX, who I knew because he had trained me at E.F. Hutton, I worked under him. He was the head of Hutton's commodity division in the mid-70s, but he stayed the chairman of the COMEX through 1980. And he imposed no buying, only sell orders. Silver's at $50. It had gone from about $3 to 50. Okay. And the market crashed. Okay. They think, oh, all they have to do is somebody on the outside, like in an exchange here or there, can push a button and stop this bull market. They don't realize what's really underneath the surface here. It's not merely exchange margin rates that are causing silver to surge too much. The 1980 intervention was draconian and unprecedented. They literally changed the rules mid-game to protect short sellers who were facing catastrophic losses. And it worked temporarily. But the world today is fundamentally different. In 1980, silver was primarily a speculative play driven by the Hunt brothers' accumulation. Today, silver's rise is driven by structural deficits, industrial demand, and global monetary uncertainty. You can't stop that with margin hikes. You can slow it, you can create volatility, but you can't stop the underlying forces. Moreover, the COMEX is no longer the only game in town. Shanghai has its own silver market. India trades massive quantities of physical silver. The rise of decentralized precious metals markets means the traditional choke points have less power than they once did. It's the industrial supply aspect, but it's also primarily the monetary issue. Silver is money. It's been money for 3,000 plus, Years along with gold, the poor man's gold, and also money recognized by various governments, including ours at one point. So that is what's going on, and there's bigger issues that are underlying that continue to drive. For example, gold is the issue of these dangers that exist and are about to implode and create even more central bank panic and printing. And that's the real driver under silver and gold. The monetary dimension cannot be overstated. As central banks around the world engage in competitive devaluation, as government debt levels reach unsustainable heights, as trust in traditional financial institutions erodes, people are rediscovering what humans have known for millennia. Real money is tangible, scarce, and outside the control of governments. Gold and silver fit that description perfectly. Fiat currencies do not. And unlike previous monetary crises that were isolated to specific regions or countries, what's brewing now is global in scope. The dollar's reserve currency status is being challenged. The euro faces existential questions. The yen is in long-term decline. Emerging market currencies are volatile and unreliable. Where do you park wealth when all fiat currencies are suspect? Precious metals become not just attractive, but necessary. Forget $50, that number is already obsolete. According to Michael Oliver, we're not just headed for a higher silver price, we're leaving the old paradigm behind entirely. For decades, silver has been boxed into a range between 0 and 50. It flirted with breaking out in 1980 and again in 2011, but each time it was slammed back down. This time, Oliver argues, is fundamentally different. His analysis points to silver entering a new reality, a zone where triple-digit prices aren't just possible, they're inevitable. He doesn't see another short-term spike. He sees an entirely new valuation structure forming, one that reflects decades of suppressed momentum now being violently released. And he's not pulling numbers out of thin air. When you adjust for things like M2 money supply growth, inflation, and dollar devaluation since the 1980s, silver's fair value could already be somewhere north of $200. But here's the catch. Markets don't stop at fair value. They overshoot. They get irrational. They correct too far in the opposite direction. So if $200 is justified, Oliver believes it could climb even higher before this run cools off. And here's what makes it even more compelling. Unlike copper, lead, or gold, silver has been uniquely trapped in this decades-long range. Now that it's breaking free, it's not looking back. The breakout has already begun, and it's rewriting the boundaries of what silver can be. The concept of fair value is important, but also limited. Fair value assumes rational markets operating on fundamentals. But when markets have been manipulated for decades, when the correction finally comes, rationality goes out the window. You get overshoots. You get mania phases. You get prices that seem absurd until you understand the magnitude of the prior suppression. If silver has been artificially held below its true value for 50 years, the snapback won't be measured or gradual. It will be explosive, and it will create opportunities for life-changing wealth for those positioned correctly. So President Williams of the New York Fed a month or so ago gave a press conference or speech, and he said that the Fed is going to start, quote, buying bonds. And he didn't say he was going to do it to support that market. His excuse was to provide liquidity because it's been a fairly illiquid market, and they want to provide liquidity like a little technical issue or something. Instead, the issue is the fact that on the long end of the U.S. government debt market, you've had no recovery, no drop in rates, no recovery in the price of the bonds for 3 years. T-bonds crashed in price between 2020 highs around 190 price level on the 30-year bonds down to 117 by October of 2022. And if you look at a T-bond price chart or a yield chart the other way, it's gone sideways for 3 years. In other words, there's no recovery in bond prices. They've been trying to base, there have been repeated rallies, 3 big rallies that we can measure, and they haven't been able to get off the ground. So we're T-bonds right now in the 115s. They're still below the low of that crash low in 2022. That's how anemic they are, which means rates are staying high on the long end, which is choking to a lot of entities, corporations. Commercial real estate, for example, that they need relief not on the short end, but on the long end, and they're not getting it. This is the crisis that's unfolding beneath the surface while everyone watches stock market gyrations. The bond market is the foundation of the entire financial system. When bonds are in trouble, everything else eventually follows. Pension funds, insurance companies, banks, they all depend on functioning bond markets. And right now, the bond market is sending distress signals. And that T-bond market, technically to us, now looks like it's vulnerable for a downside in price, upside in yield. If you slip about a handful of points from where you are now, we're 115 plus. You get down around 111 on the T-bond futures. Right now, again, the T-bond March contract is trading 115 or so. That's not a big drop. But you drop that small amount, and I'm going to start to blow momentum structures that say, uh-oh, we're headed into another dive. The Fed can't stand that. The economy can't stand that. This is bigger than the stock market. So everybody in the stock market's all jubilant about this or that or AI or whatever. Oh, this sector's finally doing well. They're not looking at the T-bonds. The Fed is. And the Fed's already spending money, printing money to keep that market from doing something that it's likely to do. And that's the factor underlying the monetary metals. Because if you lose faith in government bonds, US, Japanese, UK, etc., they're all in trouble. Then the public says, what? What do I do? Where do I put my money that's, quote, safe? Because, frankly, the stock market will follow that. If bonds start to break, the stock market's going to get gut-kicked. And I think it will be. It's topping in our process anyway. Since January this year, the broad stock market is making a topping process. But those factors have yet to come into play. And when they do, what's that going to do to monetary metals? Massive fuel injection. This is the key insight. The silver rally we're seeing now is happening before the real crisis hits. It's happening while bonds are still somewhat stable, while stocks are still elevated, while the mainstream remains complacent. Imagine what happens when the bond market cracks, when yields spike, and when the Fed is forced into emergency interventions that dwarf anything we saw in 2008 or 2020. That's when silver doesn't just rise, it explodes. Because at that point, it's not about making money. It's about preserving wealth. It's about survival in a financial system that is revealing itself to be far more fragile than anyone imagined. Now, you mentioned how the fundamentals backing this move aren't just strong, they're historic. For 5 straight years, silver has been in a structural supply deficit. That means global demand has outpaced supply every single year, draining above-ground reserves and tightening the physical market. And this isn't just about investors, it's industrial. Silver is a critical component in solar panels, electric vehicles, semiconductors, and high-tech medical applications. It's the metal you can't replace. The solar industry alone is consuming silver at an accelerating pace, and with green energy mandates sweeping across the globe, that demand isn't slowing down. But here's the twist. While industrial demand is exploding, mining supply is stagnant or even declining. New projects take years to bring online, and many of the high-grade silver mines are already exhausted. That's a collision course, surging demand meeting constrained supply. Now layer in the monetary angle. Silver isn't just an industrial metal. It's money. It has been for over 3,000 years. And as central banks around the world race to devalue their currencies, that legacy is coming back into focus. Investors are waking up to the fact that silver, like gold, is a hedge against monetary chaos. So now you've got investment demand piling on top of industrial demand, all while supply continues to shrink. It's not just a bullish setup, it's a pressure cooker. And once that lid blows, the repricing won't be gradual. It'll be explosive. The perfect storm analogy is overused, but in this case, it's accurate. You have industrial demand at all-time highs and rising. You have mining supply declining or flat. You have investment demand awakening. You have central banks monetizing debt. You have inflation expectations rising. You have geopolitical instability. Each of these factors alone would be bullish for silver. Combined, they create a setup that's unlike anything we've seen in generations. Well, let me put it this way. Let's talk about gold, the mama market right now. Since legalized in 1975, gold's had 2 major bull markets. One from the 1976 corrective low, just above 100. It rose to 850 in 3.5 years. That's an 8-fold gain. Okay, 8 times the low. 2001, after lengthy pullback and then basing at a price of around $260, it finally bottomed and turned up and went to 1920. Another 8-fold move. Took it 10 years, different time span, but the same multiple gain. The conditions then weren't anywhere near like what we're talking about now. So yeah, when you look at an arithmetic chart, it looks like, oh my gosh, it's been parabolic. Frankly, I think if it ever got there, you'd go way beyond. And also, I think the next outcome of this situation that is unfolding and will suddenly now more rapidly unfold, silver stating that you'll have fundamental factors that smack everybody in the face, like jeopardized government bond markets, central banks out of control, and you'll find gold and silver possibly being monetized in this country, that country, this country. And what will drive that is the pain that hits the public in these various countries and also their sense of uncertainty. And the one thing that makes them feel certain, growing affection for the monetary metals. So I think once this next bull occurs, it is not likely to collapse. It's likely simply to become institutionalized. It's already becoming that way. We're close to that in certain countries in the world. And if this crisis hits as we think it will, it's going to be far more broad. Even the Western countries will suddenly have to rethink their notion of what's acceptable. What's a good norm to proceed on? Is it still central banks playing their boom-bust games? Every other year or so they inject money, the stock market goes up, then suddenly it busts, and they inject more money. You get the point. And so I think we'll have a rethink where instead of a, quote, bubble top, Yeah, you'll have some sell-off, but I think you're going to likely be institutionalized at much higher levels, and a lot of that movement could occur this coming year. The idea of remonetization is profound. It means governments officially recognizing gold and silver as money again, not just collectibles, not just commodities, but actual monetary instruments. Several countries are already moving in this direction. Russia has linked rubles to gold. China is accumulating massive gold reserves. Central banks globally are buying gold at the fastest pace in decades. If this trend accelerates, if major economies begin backing their currencies with precious metals, or allowing gold and silver to be used in settlement of international trade, the implications are staggering. It would represent a complete reversal of the fiat experiment that began in 1971 when Nixon closed the gold window. Most bull markets climb a wall of worry, but this one is steamrolling through it. Silver isn't following the usual playbook, and that's exactly what's catching traders off guard. Investors are conditioned to wait for patterns, a dip to buy, a pullback to re-enter, a consolidation before the next leg higher. But this bull run isn't offering those luxuries. It's whiplash volatility with no warning signs, no clean technical setups, and no mercy for hesitation. Michael Oliver's warning is clear. Don't expect a tidy staircase up. This is a momentum avalanche, and if you try to time it, you'll likely miss it. Just look at what happened when silver dropped hard last week. Anyone who tried to step out and wait for a base is already locked out. The rebound was immediate. No basing, no confirmation, just straight back up. And while many fear margin hikes or exchange interventions, Oliver says those tools are losing their grip. The CME raised margins by 13%, and silver still surged. Back in 1980, they killed the bull by banning buy orders. That kind of heavy-handed move could crash a market. But today, the driver isn't just leverage or speculation. It's physical demand, monetary pressure, and structural change. The game has changed. And the longer investors wait for a familiar entry point, the further silver races ahead without them. This isn't a market you trade. It's a movement you ride or get left behind. Yeah, copper was in a range from the 1970s, 80s, 90s into about 2005. Basically $1.50 to 50 cents a pound, up and down, just like silver $50 to $5, for 50 years. Well, copper was in one for multiple decades. And in late 2005, it emerged above the top of that price range. Now, no doubt momentum factors would have told you ahead of time that's going to happen, just like it did with silver, for example. But then price broke out of the range. But what happened is it went to a new reality that was quadruple the average price of that prior reality, which let's call it $1.50 to 50 cents for decades. And suddenly you went into a range that had highs at $4.50 to $3. And you could draw a sideways line since about 2006. Of course, copper is living in this zone of price that if you took the average of that price zone versus the average of the old price range, it's like a quadruple. And that occurred in a matter of a couple quarters, the movement from one to the other, and then you're in a new reality. The same thing happened at a different time totally. So not coincident with copper with lead. Lead had been in the multi-decade range, broke out, and it quadrupled in a matter of a couple quarters and lived in a new reality. Now there's arguments, and they're no doubt valid, that silver's been restrained. Well, to the extent it's been restrained and an error has occurred, a pricing error. And when a market makes an error and compensates for it, whether it's an excessive upside or excessive downside, quite often the compensation for the error overshoots the new, more valid reality that it should have been in. So if silver should be in a $200 to $300 range, maybe it goes to $500 first. It overshoots it because, excess begets excess. And so I think what we're going to see is something along that line. And I think silver has even more arguments than copper or lead did. We know what they are. And it's not just the industrial aspect of silver, it's the monetary underlying massive wave that it's riding. The historical precedent from other commodities is instructive. When long-suppressed markets finally break free, they don't just rise modestly to fair value. They explode to levels that seem irrational, then eventually settle into a new, higher range. Copper did it. Lead did it. Oil has done it multiple times. And each time, the majority of market participants missed the move because they were waiting for a more obvious entry point. Silver has all the same dynamics, but amplified. It's been suppressed longer. The fundamentals are stronger. The monetary component is more urgent, and the supply-demand imbalance is more severe. If copper and lead could quadruple their trading ranges in a matter of quarters, what could silver do given its unique characteristics? So where is all this going? Michael Oliver says we're heading into a new reality, and the key word is new. Not just higher prices, not just another boom and bust cycle, but a redefinition of what silver is worth in a world that's breaking from financial convention. In his view, silver isn't just reacting to supply and demand, it's responding to something bigger. A shift in global confidence in fiat currencies, in central banks, in the idea that paper promises hold real value. And as that confidence crumbles, silver is reclaiming its role, not just as a metal, but as a monetary anchor. That's why this isn't the end of a run. It's the start of a repricing, a process that could carry silver into the hundreds and beyond before this cycle is done. And when it finally ends, it won't be with a whimper. It'll be with everyone looking back and realizing they missed the moment that changed everything. So, if you've been waiting for confirmation, understand this. It's already here. The breakout happened. The clock is ticking. And the longer the world ignores it, the more violent the revaluation will be. The choice facing investors right now is stark. You can wait for more confirmation, more data, more obvious signals. But by the time those arrive, the easiest gains will be gone. The move will be well underway. And you'll be buying at prices that already reflect much of what's driving this surge. Or you can recognize what's happening in real time. Understand that massive structural changes don't announce themselves with fanfare. They reveal themselves through subtle indicators that only a few are watching. The silver to gold spread breakout, the persistent supply deficits, the bond market warning signals, the unprecedented monetary expansion. These aren't future concerns, they're current realities. And the window of opportunity to position ahead of the crowd is closing, not in months or years, in weeks, possibly days. Because once this move accelerates further, once it captures mainstream attention, once the financial media can no longer ignore it, the easy money will have already been made. The question isn't whether silver will reach triple digits. The question is whether you'll be positioned when it does. Because this isn't just about making money on a trade. This is about preserving and protecting wealth in an era where traditional safe havens are revealing themselves to be anything but safe. If you want to stay ahead of what's next in the silver market and the broader financial reset, make sure to subscribe to Currency Matters and never miss an update. And remember, this is not financial advice. Always speak to a licensed professional before making any investment decisions.